the world's largest retailer, issuing a disappointing outlook, signalling another rocky year ahead. The CFO said this: there's a great deal of uncertainty looking out to the balance of the year. There's still pressure on the consumer. Our guidance reflects a cautious outlook on the macroeconomic environment. Abby has more. Hey, Abby.
Hey, John. Well, it's such an interesting divergence given the fact that we've had some of the luxury items and travel and leisure outperforming, but here we have staples, these big box retailers having a tough time. Walmart, in fact, right now having its worst day of the year, stumbling the most, down the most since November of last year. And it does have to do with that outlook for profits. The big deal here is last year it was also a drop for profits, this first time in 6 years. So now we're looking at 2 annual slides in profits potentially in a row. Investors really not liking that. And it seems that some of the issue, it continues to be the fact that inventories last year, we had that inventory build, that they haven't had a quick rebound out of it. They also misjudged the product mix amid soaring inflation. They had apparel and other items, too much of those items, but it was staples and really the staples that really did much better, including food, groceries. We also had health and wellness. Food and groceries up high to mid-teens. Overall, just a mid-single-digit comp. So a similar story for Home Depot. Their do-it-your-home projects are slowing, apparently. They have also forecasted a drop in profits. Part of that is a $1 billion investment to gain and retain quality hourly workers to create the shopper experience that they want for their consumers, their clients. However, considering that drop, that they have a drop in demand, some analysts are saying this is really a risky bet. John, this is incredible. They are looking at a 0.3 drop in same-store sales. Compare that to 31% higher just in 2021. It's really been a stark turnaround to the downside for Home Depot.
Home Depot down 3.7% in early trading. Abby, thanks for that. The outlook for earnings not tremendous. The outlook for labour costs not encouraging. We'll pick up on that story in just a moment. We'll do that as well a little bit later with the Walmart CFO, Kelly and Guy, catching up with John David Rainey a little bit later this morning, 10:30 Eastern Time. Look out for that. Look out for this too. Another stock to watch. Manchester United, the bidding war heating up with Britain's richest man, Jim Ratcliffe, and Elias Paul Singer all getting involved. The deal could represent the biggest takeover of a professional sports club on record. That stock coming in about 3%. Guy Johnson in London on this story. Guy, the bidding, does it continue?
It looks like it does, though I have to say the Glazer family look like they're getting quite ticked off as well about some of the comments that are being made about the club. Talk of returning Manchester United to the glory years, maybe a reference to the way that maybe the Glazers have managed the business and maybe the lack of silverware that has been generated during that period. So it's not inconceivable that this sale doesn't go ahead, John. The Glazers actually hang on to the family, hang on to this as a family business. We'll see what happens. Jim Ratcliffe, as you can see on the left-hand side of your screen, Britain's richest man, a Manchester United fan. He wants to take the club over. He basically wants to buy out the Glazers, i.e. the shares that they own, but that would involve debt. You've got Sheikh Jassim as well, out of Qatar. He is talking about a debt-free offer for Manchester United, which would mean maybe more investment into the club going forward. But then there's the issue as well of the fact that the Qataris also own PSG in Paris Saint-Germain, and maybe that would be an issue when it comes to European football.
A guy just on Elliot, Paul Singer, what's the latest with that? Is that a minority stake he's offering?
No, he's not offering he's offering financing, John. He's not offering to buy a stake in the business. So Elliot's basically talking about providing financing. It is not talking about taking a direct stake in the football club. So it is a more of an arm's length element to the story that is coming through. But the US banks, it's fascinating. There's a great story on the terminal today talking about the fact the US banks have really woken up to what is happening with football, with soccer, and are now playing a major part in terms of the financing packages that are being offered. But that's the Elliott role in this story.
Fascinating. I just wonder, Guy, if that might be the reason why the stock's pulling back today.
Maybe. There's certainly the possibility that it doesn't go ahead. It's interesting, Liverpool Football Club, which has been talked about as well as being potentially on the block, that is now no longer going forward. So there are some issues here, and I think the Glazers are a little annoyed about the fact that like Sir Jim Ratcliffe's talking about returning the club to the glory years. I think that probably is annoying a few people within the Glazer families. Maybe they're going to say, you know what, we're going to stick with it. Manchester United are on a great run now. People are talking thinking about winning silverware this year. So maybe that would be the moment that they would want to exit.
Rashford getting it done. I could continue this for a long time,
Yeah.
Guy. This was fun. Thank you. Let's do this again. Guy Johnson, any excuse to talk about football around the opening bout in New York. Manchester United down about 3.7%. US-listed China stocks getting hammered. The nation's biggest internet companies ramping up their spending as Beijing eases its crackdown, fueling fresh margin concerns. Kaylee Lyons joins us now with more. Hi, Kaylee.
Hey, John. Yeah, this is the idea that the shackles are coming off after so many of these companies have been really trying to play it low key for so long. Now that Beijing is easing up on that crackdown, they're starting to try to compete more heavily. So you are seeing some moves in the market related to this. The most prominent example today, JD.com, those ADRs down about 8.4% right now. The latest news there reportedly is that JD is getting ready to roll out a $1.5 billion subsidy program next month in order to fend off competition from other players like PDD Holdings. That apparently those subsidies will be for both JD self-operated storefronts as well as third parties. And there's other examples of this too, like Meituan expanding in Hong Kong, getting ready to hire 10,000 new workers in mainland China as they embark on a campaign to fend off heightened competition in the food space from players like ByteDance. Then there's also the news we got a few weeks ago of Baidu getting ready to launch its own AI chatbot, trying to steal more ad revenue from the likes of Alibaba and Tencent. So these companies are trying to snatch more market share. You aren't seeing, though, a great positive performance for many of these stocks, at least those listed in the U.S. When you look at the ADRs of some of those large cap tech companies as measured by the Golden Dragon China Index, we're now off 11.7% from the recent high at the end of January. So adding to those losses this morning, you have JD, as I said, down about 8%, Alibaba down about 3%, and Baidu down about 2% in the first few minutes of trading as well, John.
Kaylee Lyons, welcome back. It's good to have you back down in Washington, D.C., covering some of these regulatory stories for us. Your equity market pulling back a little bit, 7 minutes in, down 0.9%. Keith Leonard at Truist seeing a lose-lose situation for markets. He wrote the following: we see a reverse taper trade underway. If the economy stays stronger, central banks will maintain a tight monetary policy, putting a cap on equity valuations. Or if the economy starts to weaken, this will likely translate into lower corporate profits and challenge asset prices. Keith joins us right now. Keith, for those who don't remember, and thanks for being with us, can you remind us of what the taper trade was?
Sure, Jonathan, and great to be with you. Yeah, in 2010, coming out of the financial crisis, the market has started to move up, and there was a lot of angst for the market. And David Tepper came out very succinctly, said we have basically a win-win situation. Either the economy is going to get better, and that's going to help corporate profits and help the stock market, or instead, the Fed will step in, which will also help the economy. So our point of view, Jonathan, is today is somewhat of the reverse of that, in that either the economy is going to get stronger and the Fed's going to stay tighter, as you just alluded to, or as we saw with Walmart today, that the economy will start to weaken, and that will hurt corporate profits as well. So the bottom line is that we think the upside is somewhat capped. And then in the first week of February, we actually took down equities and raised some cash in light of that.
So, Keith, a lot of people at the start of the year said the same thing, and now the Nasdaq's up 13%, pulled back from those levels this morning, of course, but up double figures. What happened, Keith?
Well, I think perspective is helpful, Jonathan. So the market's had a nice move, as we change the calendar. But look at the S&P. The S&P in mid-December was around 4,100. We're below that today. So what happened, Jonathan, is that we had a sell-off in mid-December, about 5 or 6%. You had tax loss selling. As that subsided, the market has come back. But again, if you remove the calendar, we're basically just where we were back in September. And then going to technology, what we saw, we did an interesting study in January, Jonathan. The bottom 50 stocks in the S&P, which were down over 50% last year, in January alone were up 40%. Every single one of those bottom 50 stocks were up. So what does that tell you? That's not fundamental. That was a mean reversion trade. And part of the reason why we raised cash earlier in February was thinking that was just, an overdone reversion, not the start of a new bull market, which I guess, is the open question out there. But we're on the side that it's not the start of something new.
I think that is the open question. So let's go there. It's whether October was the low of this bear market. And Keith, whether what we've seen year to date is the beginning of something new. And Keith, I'm more interested in how you work out that answer than the answer itself. What's the process you go through to try and consider whether October was the low?
Yeah, well, I think the important thing, Jonathan, is we have to keep an open mind to different outcomes, especially in this post-pandemic world. So I'll give you the bullish outcome, and this is more strictly from more of a technical standpoint. You made a low in October. That was the same day as a generational high in inflation, right? So you bottomed on bad news. Over the last several months, you've had very negative sentiment, and despite that, or maybe because of that, you started to move up slowly and surely. You've seen breadth participate or broaden out quite a bit. You're broken above some technical levels as well. But what holds us back from endorsing that view, and we look at the weight of the evidence, and we look at the macro conditions. This morning Walmart talked about how uncertain things are in the second half, and we look at the fundamental perspective. Recently you were trading well above an 18 forward multiple. And to put that in perspective is over the last 30 years, you're only able to sustain a level above that twice, the technology bubble or the pandemic overshoot. So the question we have to ask ourselves, is that premium valuation warranted given the macro risk? Our view is no. The other thing that you would be banking on, Jonathan, is that earnings are going to be much stronger than the street forecast. Well, what are we seeing today? We're seeing the forward earning estimates for the S&P make a 52-week low while valuations are at a premium. That's not a combination for a large upside move in our view.
Walmart recovering just a little bit. We've mentioned that stock a few times this morning. It's now down just 0.8%. Keith, the other aspect of all of this is just history. Mislav Matejka of JP Morgan kicked off the week with this line: we've never seen a low before the Fed has stopped hiking. How important is that line, Keith?
Well, it's important. We've actually used, we've done similar analysis. To be fair, Jonathan, we've also had, a 25% peak to trough correction, which is abnormal before a recession even begins, as an example. So I think, the forward guidance that the Fed has, that's changed things because things filter into the market so much quicker. So I do think about that aspect, but overall, I do agree that, history does show that it would be unusual for the market to have the low end based on that. But even if, let's forget about that for a second. Let's forget about, hard landing or soft landing. The market at this point, in our view, is banking in a very good scenario with little margin for error. And even if you say, yes, we're in the soft landing camp, well, the market, in our view, is already pricing that in, both on the equity side, and then you look at credit spreads, which are extremely tight, also not baking in much recession risk either. So we just think the downside risk is higher than the upside risk, and that's why, again, we're more defensive in our overall posture today.
The so-called reverse Tepper trade. Keith, this was great. Don't be a stranger. It's always great to catch up. Keith Lerner there of Truist. Thank you, sir. About 12 or 13 minutes into this session, equities pulling back. We're off the lows, though. We're down 0.8% on the S&P and the Nasdaq. We're down about 0.9%. Coming up, Credit Suisse, the chairman, speaking to Bloomberg back in December.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Those comments said to be leading to some regulatory scrutiny. We'll have that conversation next.
Doubt was basically half stopped. What we saw is 2-3 weeks in October, boom, and since then flattening out. They have stopped. It's gradually coming back, in particular in Switzerland.
That was the Credit Suisse chairman, Axel Lehmann, speaking to Bloomberg, and Francine Lacqua back in December. Shares this morning hitting a fresh record low after Reuters reports that the regulator in Switzerland is investigating whether those remarks misled investors. Credit Suisse declined to comment on the report. Joining us now is Bloomberg's Jan-Patrick Barnett in Frankfurt. Jan-Patrick, always fantastic to get your perspective. What's happening here?
Oh, well, it's horrible to watch Credit Suisse unable to get anything right. And now with the last thing that they want right now is regulatory scrutiny. And especially this incident probably has no good outcome for Credit Suisse because either the management has been untruthful about what outflows are actually looking. So that's an obvious red flag. Or if they have been right and just unlucky with the timing of the comments and then outflows resumed shortly after, it shows you that the management is unable to do anything to stop that bleeding for the bank. So whatever it is, it's probably not good for the bank. If you look at the share price, it's down tremendously, and that in a time when all other banks are rallying based on the higher yields. So Credit Suisse really has an issue here to renew trust from investors and from the clients. And if I have to make a prediction, I would say that this probably is going on for a little bit longer because right now, as I said, the bank is just unable to get anything right here.
The 260 on the stock does not look good. We're down another 4%. Jan-Patrick, thank you. Joining us now to discuss is Filippo Aluati, the head of financials at Federated Hermes. Filippo, fantastic to speak to you, sir, as always. There's one question I had, Filippo, just reading this story. Those remarks were made right before the close of a $4 billion capital raise. And I wonder, Filippo, whether he was communicating the same thing, whether the company was communicating the same thing to the people who bought into that capital raise.
Yeah, I think it's a bit complicated. So I think I saw the chair, and we just heard again what he said. He was on purpose a little bit vague. I mean, so you can argue that in some part of the Credit Suisse group, like for example in Switzerland, as he mentioned, they were already the deposit actually were reverting, and also he's mentioned flattening out. So these are mathematical terms, a second derivative. So you can say that on purpose, or it's been a little bit vague. And of course, I mean, we know there was the rights they were pricing because I think they only settled on the 10th of December, so before the interview with Francine. So it was a bit, should I say, I think it's one of half glass, half full, half empty type of the situation. And I think one of the duty of the chair is also to instill confidence in the group. And I think he was playing this part of instilling confidence in the group.
It's also taken our attention back to a difficult time for the bank and taken our attention away from where the bank is right now. Filippo, I wonder what the inflows-outflows situation looks like currently. What's your read on that?
Yeah, I think it's this situation, and that's based on the Q4 number they disclosed a few weeks back. It has stabilized, but it has stabilized at a cost to the P&L of the group, because so we know there's been some, I would say, punchy marketing campaign both in Switzerland and in Asia Pacific in order to get those deposit back. And I think also in this kind of situation, that's what you want to them to do in order to stabilize the, say, the funding profile of the group and have these outflows, so consign these outflows things to the past. And I think also, yeah, it's a difficult job they're trying to achieve, and to say that they all get things wrong, I think it's a little bit too simplistic.
Filippo, just a final one from me, if I may. This year is a write-off for the bank. Based on the communication we've had, it looks like 2023 is going to be very difficult to make profit. 2024 seems to be the next landing point. How difficult will it be to turn around the bank even in the next 12 months?
I think it will be difficult. The execution risk is high, and I think also they've been very upfront, at least in the Q4 call, saying we'll make a huge loss in 2023. It's possible also 24 will be another difficult year, and then also they're only forecasting a relatively pedestrian return on tangible equity by 2025. So it will take some time, and I think also we've been there with previous situations, like for example NatWest, Deutsche Bank, Danske Bank to some extent. So it takes time, it takes patience, and I think the best thing for Credit Suisse is to just stay out of the news for quite some time, but it will be difficult.
They're struggling to do just that. Filippo Aluati of Federated Hermes. Filippo, thank you, sir. Stock's down 4%, stock's trading at 266. We actually had some decent data out of Europe earlier this morning on the services side. Mike McKee, we're seeing a very, very similar story out of the US this morning.
We are indeed, John. One of your guests at the top of the show was making the case that a recession may be coming because the January data were unusually and maybe strangely strong. This is February data. The S&P Global Manufacturing PMI comes in better than expected, up from last month, 47.8 compared with 46.9. Now, that's not too bad. It is a bit of good news, but you look at what's happened with services and composite PMI, both of them back over 50. The services PMI goes up to 50.5 from 46.8, a significant move. 50.2 for the composite, also from 46.8. So two significant moves in the services and composite that put us back into expansion territory for February. This matches what we've seen going on in Europe. You mentioned that. Almost every country there had the same story as the United States, with France, Germany, the Eurozone, and the UK seeing manufacturing still below 50, although a little bit better, but services in all of those countries higher than 50 now, and the composite in all of those countries higher than 50 now. So it does look like there is more strength in the global economy. And I got to say, it may be showing that Christine Lagarde is not the most powerful woman in the European economy. It may be Mother Nature. What analysts are suggesting, and that may be true in the United States as well, is that the winter has been mild enough that people have had extra money they would have spent on natural gas or other utilities to spend, and they haven't been kept inside by storms. So maybe this year is a Mother Nature year to watch.
At least the first couple of months of the year anyway. Mike, thanks for that. The weather component of the year so far, the data's just been tremendous. I remember at the start of the year we had sub 50 PMIs on S&P Global, looking at the US, and credit spreads were at 400 basis points on high yield. And I said to Gershon Distenfeld out of AB, this does not make sense. And he said to me, one or two things needs to happen. Either spreads are going to gap out wider again, or the PMIs are going to recover. What we're seeing right now is the PMIs starting to recover. Watch this space. Your equity market down another 1%. Up next, your trading diary. The PMIs worldwide looking pretty good relative to expectations and relative to where they have been. Equities off the back of better data lower because yields are higher. We're down 1% on the S&P. On the Nasdaq, we're down a little more than 1 full percentage point as well. That's the price action. Here's your trading diary. Coming up, President Biden set to speak in Poland, 11:30 Eastern time. Fed minutes on Wednesday. Look out for that tomorrow. We'll hear from President Bostic's daily of the Fed speaking on Thursday. Plus we get US GDP, core PCE, another round of jobless claims as well. And finally, new home sales, personal income and spending numbers and new Mitch sentiment survey to round out the week. That rounds out the morning for me. Good morning. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, February 21st. Here are the top market stories we are following for you at this hour. Holy services. U.S. February services PMI is back in expansion territory, blowing past estimates, and manufacturing beats too. What does that mean for the Fed? Retail woes. Both Home Depot and Walmart drop on disappointing forecasts, signaling caution on the consumer. We'll get more insight from John David Rainey, Walmart's CFO. And the president in Poland. Biden is in Warsaw following his historic visit to Kyiv yesterday. He's expected to speak in the next hour as Putin halts Russia's nuclear pact with the U.S. and vows to press on with its invasion of Ukraine. From Washington, D.C., I'm Kaylee Lyons, along with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, 50.5 on U.S. services PMI, 50.2 on the composite. The U.S. economy seems like it's bouncing back.
Absolutely, and this is the theme that is consistent through the data, both here in Europe and in the United States. The service sector is coming back. It's in expansion territory, and this is a major problem for central banks because buried within the data as well, Kaylee, you've got sticky inflation, and that's a real problem for central banks. And it's interesting, you also compare and contrast what's happening with Walmart and Home Depot today. The high cost of service, i.e. employing people, in their stores is also a factor here. So this is a narrative that is impacting equities, it's impacting the bond market, it's impacting central banks. It is a theme that is running through developed market economies in a big way right now.
Yeah, and in the bond market in a big way. I'm looking at a 10-year Treasury yield up 12 basis points on the day to 393, Guy. And of course, we're getting other economic data as well. It is in the housing market that you really are starting to see central bank policy having an effect. Existing home sales for the month of January missing expectations, coming in at just 4 million. The expectation was 4.1 million. And month over month, down 0.7%, which is significantly weaker than expected. The average economist forecast was for up 2%, Guy. So you're seeing it showing up in one area of the economy, but perhaps not the area in which central bankers really want to see their rate hikes taking hold.
Yeah. Sticky services. A bit of breaking news. Xi Jinping is going to go to Russia. This according to the Journal. He's going to meet with Putin, and it could happen in April, potentially early May. That's going to ratchet up the geopolitical tension that we're all watching as well. And in some ways, that is inflationary too. The breakdown of globalization is another factor that feeds into that kind of structural narrative too. So let's talk about the PMI data in a little bit more detail. The service strength is the real star here. That's what everybody's focusing on. We saw it in the UK. We've seen it across the Eurozone. And now we see it in the United States as well. What should we make of it? What will the Fed make of it? Bloomberg's international economics and policy correspondent Mike McKee here to answer that question. Mike.
Well, Guy, it's a little bit less of an indicator, the Standard & Poor's PMI, than the ISM numbers for the U.S. We'll get those on the 1st of March. But the direction seems to be in a positive way, and that's significant because a lot of people are making the case that maybe January's data were overstated, some sort of statistical fluke, and a recession is still on its way. But the data just don't seem to support that, and we saw that in the numbers today, particularly across the pond. But basically the same story here and in the UK and in the Eurozone, with manufacturing coming in still below 50, although better than it had been, and services rising above 50. Now, the explanation that some economists are putting out there is that it may be, as I mentioned earlier, Christine Lagarde is not the most important woman in European finance. It is Mother Nature who is, because the winter has been so warm, and in much of the U.S., the same story. You're seeing more disposable income that would have gone to utilities, would have gone to heating and electricity, and you also see people being able to be out and about and shop or go to restaurants more than they had been because the weather is better than expected. So that may be the influence in these February numbers, but we'll have to see how that plays out longer term. One thing about the housing numbers I want to point out is, of course, existing home sales are based on 2 months ago when you sign the contracts, and 2 months ago we were seeing the mortgage rates drop, and that is basically been an idea that we would see a turnaround here, and it hasn't happened. This may be the cumulative effect of Fed tightening, and we did see prices, median prices for existing homes, drop significantly in the last month. That's something the Fed's been waiting for.
All right, really good point. Bloomberg's Michael McKee, thank you so much. Let's continue this conversation now with Chris Williamson. He is S&P Global Market Intelligence Chief Business Economist. Chris, thank you so much for being here. Let's just talk about services, both here in the U.S. and in Europe. What is going on?
Well, I think Michael raises a very good point, and it's reflected in the responses we got to the surveys, and that is the weather. Unseasonably warm weather in many parts of the world, helping boost activities outside, whether it's outdoor restaurants, whether it's recreational activities, or whether it's things like construction activity receiving a boost. Now, construction's not in the services PMI, but there's lots of ancillary services to construction. It's just an example of how good weather for a time of year can really skew the data in a positive direction. So there's an element of that here, certainly. So take it with a pinch of salt. The good numbers that we're getting in these winter months are being buoyed by the weather. There's no doubt about that. It's whether you get payback later on that's important. It's going to be interesting to see if this fades, or if we keep having good weather, does it just keep on spending, as it were? The other aspect to it, which I think is very important as well, it's related to your the housing markets. is that back in October, November, we saw, if you like, peak fear in the housing markets and the mortgage markets, just wondering how high rates are going to go. Is there a ceiling on that? People scrambling to get some idea of just what sort of terminal rates and terminal mortgage rates will look like. I think the market's getting a slightly better handle on that now, and that has helped calm some of the jitters in the market. So we've seen, for example, in Europe, especially in the UK, the biggest driver of growth in the service sector was actually financial services. Has come out of a big slump late last year to see reviving growth. Now, the UK is a special case, of course, because we had the mini budget back in the autumn, which led to a big collapse in confidence. That situation's turning around quite nicely now. But it's part of the bigger picture, service sector being driven by financial services coming up.
Chris, you say we've got to take it with a pinch of salt, so maybe we should do that. We'll wait, we'll watch, we'll see how the data develop. But within this, there is certainly a component of sticky inflation, and that is what central banks are going to be looking at within these numbers. What is your read on how sticky inflation is right now?
So we've seen the inflation forces move from manufacturing to services over the last 6 months or so, and that's continuing into February. We've got not just easing supply constraints in manufacturing, but faster delivery times. Companies supplying goods into manufacturing operations are almost getting desperate to ship their stuff now. They've got too much stock, and that, of course, leads to discounting. You're seeing increasing cases of this. So on that manufacturing side, you're getting inflationary pressures coming down really quite nicely now in terms of those raw materials. But when you look at what output prices are doing, price of goods leaving the factory gate, they're not showing the same downward momentum. And that, companies are saying, is linked to wages. And this is what we're also seeing in the service sector. And this is the big driving force behind these more elevated rates of price inflation we've got in the service sector. So here we're seeing there's always a lag. Service sector inflation lags manufacturing, and we're seeing that, of course, now. But it's just looking that little bit more elevated than we'd like to be seeing, and that's reflected this wage growth coming through. There's always this lag, so don't be too worried about it. But central banks will be concerned that this is some evidence of wage price spirals taking hold, which they will need to nip in the bud.
On the subject of wages and employment, Chris, because that really seems to be the focus here for both central banks and the employers of these people, is it still the idea that there is a shortage of labor, or that they need to retain the people that they are hiring because people are still so confident of their ability to go get another job? I mean, what is the tone of the language being picked up in the survey?
The companies are able to hire, and indeed in most cases in increasing numbers, but that's just adding to the labour market tightness. There's no doubt at all that you've got huge problems in hiring suitable staff, both in the US and in Europe, and in particular the UK, where we've got additional constraints on labour mobility due to Brexit. There is great pressure in that labour market, which is driving this wage growth. There's no doubt about it, and it's getting worse as we've gone through. Companies are getting more confident about the outlook now. Recession fears have eased considerably, and they're now coming back in more numbers into the job market. Often find they can't find the staff, and of course, what you see then is wage growth, and that's what's apparent across the US, Eurozone, and UK in these surveys.
Chris, great to catch up. Always a pleasure. Thanks for jumping in and giving us analysis on your data. Chris Williamson of S&P Global Market Intelligence. Christine Lagarde, right on cue, the president of the ECB, talking about the fact that how high rates will go will be data dependent. Well, we've just seen super strong data for the services sector. What comes after the March hike will be data dependent. Intend to hike rates by 50 basis points in March. That coming from Christine Lagarde, the president of the ECB. Coming up, more on our PMI story and our question of the day. Does the Fed have a PMI problem? Actually, I think the better question is, do we have a services problem? How high is the cost of services, I think, is the question here. We're going to discuss that with Liz Young of SoFi, head of investment strategy there. This is Bloomberg.
inflation season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money with exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We've seen some higher inflation numbers for January. I don't necessarily think that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do. And so we think another 75 basis points from here with no cuts until 2024 seems like a more likely outcome.
That was, of course, Goldman Sachs Chief Economist Jan Hatzius speaking exclusively to Bloomberg at the Goldman Sachs Global Macro Conference, which has been taking place in Hong Kong, which gets us to our question of the day, which goes to the data. Does the Fed have a PMI problem? Does the Fed have a services problem? How high is the cost of services right now? How high is the cost of service if you're Walmart or Home Depot? Liz Young, SoFi Head of Investment Strategy, joining us now. Liz, we've just seen more evidence that the economy is not slowing down in the way that many had anticipated. There is an expectation that maybe we do get a no landing or a soft landing. But on top of that, we are going to see the Fed potentially having to do more, as Jan Hatzius is talking about. What is your view of what the data are telling us?
Well, you're right that we've seen a bounce back in some activity, particularly the services PMI. You've also seen a pretty big bounce back in consumer confidence since December. A lot of that confidence data has to do with the fact that inflation has come down. And I think the headlines and the headline data on inflation has told us that inflation has come down, but you are right, too, to ask, does the Fed have a services problem? I do think that they will end up having a bit of a services problem. I don't think right now there is a huge alarm bell going off. Obviously, we've got activity coming back, and we've got a decent amount of optimism in the current economic data. But when you look forward about 3 to 6 months, if that services inflation stays high, the overall number is likely to get stuck at a level that is above where the Fed is comfortable. And I think that's really what's giving investors some consternation today, and we're seeing a sell-off in the markets as a result.
Well, it's not just a problem for central banks either, arguably, Liz. It's a problem for corporate America. If you just look at Home Depot saying they have to spend another $1 billion to pay people more in their stores. Is this a corporate profit problem, too?
Yeah, well, again, today, maybe not. But in the next 3 to 6 months and throughout the rest of 2023, I would expect profit margins to continue to compress. They've already come in quite a bit. The good thing about it, and this is where some of the soft landing camp comes in, is that we started all of this market pressure with record high profit margins. So there was a decent amount of what I'll call bubble wrap around the profit margin story. There was also a decent amount of bubble wrap around wage growth, and there's a good amount of bubble wrap around the labor market. So there's a lot of pain that can be withstood in some of this data before it really becomes troublesome. But as we're hearing slowly from companies, profit margins are expected to come down, and it's really the mix of how high will revenues stay versus how much can they cut their costs in the meantime.
Liz, do you think margins are going to be structurally lower post-pandemic than they were pre-pandemic?
That's a tough one to answer. I think it's probably going to be different by industry. I think there were some industries, particularly technology, that perhaps overhired. We're hearing about a lot of that data now and are going through a lot of those cuts up front. So if it was an industry that was bloated and doesn't cut costs enough, and I think this is a really difficult thing, and it's something that I think investors need to keep their eye on, is that companies basically have to manage their operating margins perfectly in order to get through this without having a meaningfully compressed margin at the end of it. So if it was overly bloated on cost coming into this and they don't cut enough to offset basically the revenue decline, then yes, the profit margins in those particular industries will be lower than what they were pre-pandemic.
Okay, so Liz, take that profit margin story and the central bank story and filter it through to where equities are currently. How appropriately are they priced? Mike Wilson over at Morgan Stanley saying this morning that the risk reward is very poor because the equity risk premium has entered death zone levels.
Well, I won't be quite as dire about it, but I did actually tweet out today something about the equity risk premium being as low as it has been since 2007. So it is at a point where equity markets feel like they're a bit overpriced given where we are. I do think the Fed still has to do more, and we all know about the long and variable legs that it takes for monetary policy changes to move their way through the economy. So I think equities are not offering a great opportunity here from a valuation perspective, because basically you would have to believe that we deserve to go through multiple expansion, meaning that prices deserve to continue going up without earnings growth to back that up. So it's difficult for me to look at this in this environment and say, yes, we should be paying 18 times forward earnings.
What about bonds, Liz? I've got a 10-year that's up by 10 basis points on the back of the numbers that we've seen today. We're trading at 3.92. Obviously, you've got a 2-year that's significantly above that in terms of the yield. A lot of people have been saying that bonds are the place to hide out, but obviously recent evidence maybe points against that. Are we about to go into an environment once again where bonds and equities are selling off at the same time?
Yeah, it's pretty remarkable what's happened in the bond market. I mean, we've got a 6-month above 5%, a 1-year above 5%. I do think that there's good opportunity, particularly in the short end of the curve, so that 2-year and below portion of the curve for investors who are not willing to jump into equities at this valuation level, but do want a yield. And this level of yield we haven't seen in decades in the Treasury market. So I think it's really interesting as a place to kind of park cash and actually make money on that. Where I would be careful in bonds is, number one, at the long end of the curve. So we're seeing inflation expectations rise, and they've risen pretty dramatically since the last FOMC meeting. As inflation expectations rise, you likely see the long end of the curve get kind of sticky in that higher yield portion. So I would be careful about the longer end of the curve. I'd also be very careful in corporate credit right now. I think that spreads are way too tight given where we are in the economic cycle and given some of the stress that has occurred in the equity market. Corporate spreads are just really, really tight, both in investment grade and high yield.
Yeah, a really good point. 426 basis points on high yield spreads at the moment. Liz Young, thank you so much. As always, great to see you. She is SoFi Head of Investment Strategy. Now, still ahead, a showdown between Microsoft and EU antitrust watchdogs. We'll look at the challenges to Microsoft's takeover of Activision in the startup next. This is Bloomberg.
Day, like Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Home Depot is forecasting a decline in full-year earnings. The outlook signals a slowdown in do-it-yourself spending at the home improvement retailer. Meanwhile, Home Depot is spending $1 billion to increase hourly wages in a tight labor market. It's never been this cheap to buy a Tesla after a series of price cuts. In the past month, Tesla's Model 3 sedan now sells for $4,900, less than the average new vehicle sold in the U.S. According to a Bloomberg analysis, that's the cheapest price Tesla has ever had relative to the typical U.S. vehicle. And that is your latest Business Flash. Guy?
Ritika, thank you very much indeed. It is 7:20 on the West Coast, so let's get to the startup when we cover the top tech stories from the Bay Area and beyond. And we're definitely focusing on the beyond today. One of the biggest stories we're watching today, actually out of Europe. The hearing of Microsoft's takeover, $69 billion, I think it is, of Activision, kicking off in Brussels today. Joining us now from there is Bloomberg's Max Ramsey. Max, let's talk about how significant this hearing could be for this deal. The UK has already poured a bunch of cold water on this transaction. What are we expecting out of Brussels?
Well, Guy, let's remember this is a massive deal. You're totally right, $69 billion. So that's always going to come under scrutiny in any industry, especially gaming. We have heard from the UK already, the Competition and Markets Authority. They raised major structural issues, and actually Microsoft and interested parties have until tomorrow to respond to that. The EU has actually already given some initial findings to Microsoft. That, along with this hearing in Brussels today, is something that then Microsoft can respond to with remedies for any issues. And of course, they still face a long road ahead in the US, where the FTC is formally suing over this. So, I mean, a lot of challenges for this. You have got key figures from Microsoft here today. We did hear from Brad Smith, the president, commenting to our colleague Stephanie Bodoni earlier on the way into the hearing, saying this will provide more competition, more games to more people, but a lot of regulatory challenges in many jurisdictions for them.
Yeah, they're just going to deal with Nintendo, maybe to put it on Call of Duty on the Switch. Many people saying that maybe those sort of remedies won't go far enough. Max, we'll look forward to the continuing coverage as to what is happening here. Really appreciate you jumping on the phone for us in Brussels to give us an update on what is happening here. What do we got coming up for you on this show? Walmart's outlook, very much disappointing. Shares under pressure today, this after forecasting a second straight drop in annual profit. We are going to be joined by the company's CFO, John David Rainey, next. The market reaction has been quite interesting today. It's been whipsawed all over the place. We're going to get John David's take on exactly what is happening, particularly on the services side. We've just seen the PMI data coming through, very strong service sector story, and you're seeing that reflected in the Walmart numbers as well. We'll get John David's take on that. That is next. This is Bloomberg.
We are an hour into the U.S. trading session, and it's not looking pretty at the moment if you are long equities. Bloomberg's Abigail Doolittle is tracking the moves for us. Abigail, it's not just a stock move. There's a pretty big bond move as well.
It is, and it feels a lot like 2022, in fact, Kayleigh, because we do have yields up, and that seems to be pressuring stocks. Take a look at the 10-year yield right in the middle of the board, up 10 basis points at 392, one of its highest levels of the year, if not the highest level of this year. That is pressuring stocks, making stocks look more expensive, liquidity coming out of the system. So we do have the S&P 500 right now down 1.4%, down for a third day in a row, the worst 3 days of the year. So the rally that we have, we do still have the S&P 500 up about 5% on the year, but we're having a little bit of a pause here. We also have oil, another risk asset, down about 0.6%. Now, Mike Wilson, of course, one of the big bears last year very correctly, this year a little bit more difficult. He's saying that you really want to take a look at the risk premium of the S&P 500. If we take a look at the terminal, we are going to see that the spread between the S&P 500 dividend yield and the 10-year yield super low, about 1.22%. Mike Wilson is saying this is not enough. As for some of the stocks trading on the day, we do, of course, have lots of earnings out there. Now, Walmart, this is really interesting. We're seeing this stock flip higher. Earlier, it had been down more than 2%, the worst day since November. But again, higher investors digesting the fact that they have taken the outlook in, still trying to rebound from swollen inventories last year and a little bit of a product mix issue. Home Depot, though, still down. They cut their outlook, spending $1 billion to retain and attract high-quality talent. General Mills, on the other hand, they boosted the outlook. And Kayleigh, let's take a quick look here at what we have going on for Walmart, because we are going to see one of the concerns earlier for investors is this 2-year decline of earnings for the company. But it seems that investors are looking past it, maybe thinking that Walmart is guiding light here or making it easier for investors or for them to make their numbers.
Yeah, Abigail Doolittle, really interesting story. Thank you so much. Walmart was down as much as 2.9% at the opening bell, was on pace for its biggest opening drop since November, as Abigail said. Now we're up about 0.5%, even though the outlook technically did come up short of analyst estimates. I wonder how much of that is maybe seen as overcaution on the U.S. consumer, perhaps some upside to that earnings story if the consumer proves more resilient than expected. We welcome now our Bloomberg TV and radio audience and listeners. Walmart CFO John David Rainey is joining us. John David, thank you so much for being here. Great to have you. Obviously, your outlook did come up short of what the street was looking for, yet you are starting to see a rebound in the stock. As we talk about the macroeconomic uncertainty that you described, the health of the U.S. consumer, would you describe Walmart as being overly cautious here? How much upside room is there to your view?
Well, there's a lot that we don't know about the economy as we're sitting here just a couple of weeks into the fiscal year for us. We had a really strong fourth quarter where we grew the top line over 8% and saw adjusted operating income growth of north of 6%. And performed a lot better than we expected at the beginning of the quarter. And so you're seeing that our value proposition is certainly resonating with consumers right now, but there's a lot of macro uncertainty. Again, as we look across the consumers across the globe, but certainly here in the U.S., balance sheets are getting thinner. You're seeing savings rates decline, and we really haven't been in a position where we've seen the Fed tighten at this rate. And so as we look forward and give guidance for the full year, we're adopting a cautious outlook, and we want to make sure that we're responsive to whatever environment that we're going to find ourselves in.
John David, this is fascinating because I hear this story from so many companies, and basically what they're saying is, actually, we're okay right now. Things are working. We've just had a great quarter. But we keep hearing about all these macro factors that we need to worry about, and as a result of which we don't know what's going to happen. But at the moment, we're fine. Is that how you would describe your story here at the moment? You kind of listen to people like us talking about the macro headwinds. You listen to what the Fed is saying. You look at the data. And you see risks there. But at the moment, that is not what you're seeing in terms of your footfall and your business. Is that how you would describe it?
I think it's fair to say that. I'd characterize it maybe slightly differently in that we've seen, maybe even been surprised by the resilience of the consumer and consumer spending. They've been more discerning in this environment, more selective when they're shopping, looking for those discounted price points, looking for when things go on sale to buy larger ticket items. And they've been spending more of their disposable income on things like food and gas. And how long that lasts is anyone could probably better answer than me. But that's partly why we have a cautious outlook for the year, because we simply don't know what we don't know right now.
Well, on the subject of that consumer behavior, something else that we have seen and that Walmart has benefited from is those at the higher end of the income scale trading down, if you will, and shopping at lower cost retailers. How much of that do you expect to retain? How do you retain it?
Well, again, we're seeing that our value proposition is resonating with consumers. If you were to go back a couple quarters, we've been seeing consistent share gain, particularly in the area of food and consumables. And 2 quarters ago, probably 70 to 80% of that share gain was coming from households that had income north of $100,000. What we've seen in the most recent quarter is that we've actually had share gain from some of the lower and middle income buckets as well. And so as these consumers are being more discerning, as they're looking for value, and importantly, in a world where convenience really matters, our value proposition is resonating with them.
John David, do you think that's going to be able to continue? The hard discounters must be pressing you pretty hard at the bottom end. I appreciate that you're bringing new consumers into the top, but is the risk that you lose them at the bottom to the hard discounters?
Well, if you go back last year, certainly with some of the supply chain issues, you saw a very competitive environment with respect to markdowns. We at Walmart are in a much better position with our inventory right now. And so I think relative to last year, you'll probably see less markdowns on the margin at least. But again, like we're a company that does well when the consumer's pocketbook is tight and they're looking for value. But we're also a company that does really well in good times. As we're continuing to evolve and expand our business into a lot of other initiatives that go far beyond just simply being a retailer that people go to with price. One of the data points that we highlighted on the call earlier today is that consumer mindshare scores or consumer sentiment, we actually score as high for convenience now or almost as high for convenience as we do for price. So in the past, we've always been thought of as a company that consumers would go to when they're looking for price, but we're also providing the same for convenience as we expand the initiatives that we're offering our consumers.
Well, let's continue talking about price and talk about the price of labor. What kind of wage pressures are you seeing among your workforce, considering we just saw a blowout on the services PMI number here in the U.S.? We've seen Home Depot today, another retailer, talking about spending $1 billion more to pay higher wages to their employees. What is Walmart seeing?
Yeah, we're still continuing to invest in our associates. That's an important aspect of who we are. We're a people-led, tech-empowered business, and we want to continue to invest appropriately in them and give them ladders of opportunity at Walmart. And so we announced about a month ago that we're continuing to invest in those associates with pay increases for many of our associates in the U.S. And so that puts some pressure, certainly on the expense side of the business, but we're able to do that while still seeing that or expecting our operating income to grow at a faster rate than sales.
John David, you talked a moment ago about the macro uncertainty that you're seeing. What about the geopolitical uncertainty that you're seeing? We are, day by day, it seems, ratcheting up tension between the United States and China. How are you rethinking your supply chains in the light of that geopolitical risk?
Well, the vast majority of our supply chain or the goods that we buy come from the U.S. And so we certainly are dependent upon China, but we try to maintain sort of a diversified approach to that and not become too dependent upon one area of the world. But the geopolitical environment just broadly, not necessarily with respect to China, does have an impact on our business. Even if you look at what's happening right now in Ukraine, the grain shortage there has an impact on rice prices, which we're then seeing our consumers pay as much as 20% more for things like that. And so we're very mindful of that, but we've always been able to take a diversified approach to this so that we can continue to provide that value for our consumers with everyday low prices.
Well, let's talk about the diversity of your different businesses as well as some of those ancillary businesses you're developing for your so-called flywheel. Digital advertising seems to be generating meaningful revenue, but are you behind schedule on healthcare and financial services?
Not necessarily. These are emerging businesses for us, and if you just take healthcare as an example, we're the third largest pharmacy in the United States, and so we're continuing to invest. This is a huge addressable market, and with respect to financial services, we've seen time and again that consumers value those services where you have that digital engagement and you allow them to avail themselves of other financial services that traditionally they might have to go into a bank for to be be able to do that through a mobile device in the palms of their hands. And so this is really us following the customer. I wouldn't say that we're behind by any stretch. Fortunately for us, given our customer base, we've got tons of opportunity in terms of how we continue to change our business.
John David, final quick question from me. Do you think margins are going to be structurally lower post-pandemic than they were pre-pandemic?
Well, I can't speak for the rest of the industry. I can tell you what's going to happen in our business, and what we're seeing is that our business continues to evolve. When we look at some of these faster growing, higher margin businesses like Haley just alluded to, these are contributing more to our business year over year, and that's one of the reasons that we're actually seeing our margin structure go up. It's obscured a little bit this year because of some of the macroeconomic pressures that we have, but as we look forward into the out years, we should continue to see better and better margin performance because of these faster growing, higher margin businesses.
And the stock rebounds. John, thank you very much indeed. Sorry, John David Rainey, Walmart's Chief Financial Officer. Sir, thank you very much indeed. Coming up, more on US retail earnings. We've also got Home Depot to consider as well. Shares not rebounding there, in fact, slumping after forecasting lower profits. We're going to speak to a money manager who's invested in real estate and home builders. Bill Smead, Smead Capital Management founder and CIO, joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishka Gupta. Vladimir Putin is suspending Russia's observation of the new START treaty with the US. That's a blow to the last accord, limiting their nuclear arsenals. In his State of the Nation address, Putin also warned the US and its allies not to provide Ukraine with long-range missiles. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. And Goldman Sachs sees the Federal Reserve raising interest rates by a 1/4 percentage point at its March, May and June meetings. The bank's chief economist, Jan Hatzius, told Bloomberg he also thinks there will be no rate cuts until 2024. Hatzius cited higher inflation numbers for January. Global News powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Guy.
Rika, thank you very much indeed. So we just heard from Walmart, which is bouncing back. Now let's turn our attention to Home Depot, which is not having quite the same share price reaction. So shares of the home improvement giants under a little bit of pressure today. This after it forecast lower profit. The company also said it's investing billions of dollars in wages in the face of a tight labour market. Joining us now, Bill Smead, Smead Capital Management founder, chairman and CIO. Home builders, REITs, big part of the portfolio. So Bill, what do you make of what Walmart had to say today? Basically, the cost of service is going up and they're having to pay it.
Well, they left out one ingredient. So we look at this and we say, wealthy people that lose money in the stock market, they pretty much keep spending because they did so well the last 10 years. He mentioned people at average and below average incomes, their income is going up substantially. And so they make really good customers. And then there's a third dimension that he didn't mention. There's 92 million millennials that are forming households and are engaging the kind of spending that's necessity based. And as soon as you go to necessities, that's really good for Walmart and ultimately for Home Depot. Home Depot's problem is very simple. It's a category that's going to do really well over the next 10 years, but is temporarily negatively impacted by what the Fed is doing with tightening. And again, the stock market is designed to move money from impatient people to patient people. And if you're in this market right now and want to make a lot of money in 6 months, you're in trouble because this market is designed to punish the sins of the bull market that came before this.
Bill, you mentioned their Home Depot having a Fed problem essentially because you were seeing the effect of tightening showing up in the housing market, therefore there's less DIY spending. But Home Depot also has a labor problem. I mean, what do you make of the $1 billion they say they're going to have to pay to increase wages to get people in the stores to serve customers?
No, that's not a labor problem. That is reality. The reality is we're in an inflation cycle. Welcome to the 1970s, right? You had $7 trillion worth of federal government borrowing get monetized, and you're leaving the poor Federal Reserve to try to solve a problem that is created by too many people with too much money chasing too few goods. So there's $7 trillion sloshing around out there, and you heard it, the Walmart people, they don't know, what's going to happen because this is the most government spending get monetized since World War II and the Great Depression. So again, you got very favorable demographics. You've got people pivoting from discretionary spending to necessity spending, and then you're going to have a ton of households get formed the next 5 years because the number of people getting married last year and this year is the most in 10 years. So we're very optimistic about the economy, even if there is a recession. As I like to always kid people, if the economy contracts 4%, people divorce their stocks. If your spouse loves you 4% next year, would you divorce your spouse?
Let's talk about the read across. I hope my wife's not watching. Let's talk about the read across into the housing market right now and figure out what is going on there. Is there a read across from Home Depot into housing? Housing obviously has been hugely susceptible to the rise in rates that we've seen.
You know, it's really remarkable, and I'm glad you brought it up. Again, I don't know what the stocks will do in the next 6 months. As the Fed tightens credit, it'll probably be tough on the home builder stocks. However, you have to understand what happened. We were in the process of heading to building 1 million homes in 2021, and supply chain issues stopped them from doing that. And then the Fed tightening stopped it from going up last year, and it's going to be difficult now. But there's 92 million people. It's 40% more humans than in the prior household formation group that are going to need a home. So the only way to cure home prices is to build homes. So the runway the next 5 to 10 years is spectacular. So we're happy to sit through the abuse for a while in the Hortons and the Lennars and the NVRs, because the next 10 years are going to be great. That's what we do. We're 5 to 10 year investors, and we let the world come and go around us and don't get caught up in that.
But how much worse will it get before it gets better, Bill?
Well, it's funny. There's a big spread between the 10-year Treasury, even today at close to 4%, and what the mortgage rate is. A much higher than normal spread, so the mortgage market has kind of anticipated a additional tightening from where we are. But let me tell you, for a person that's first mortgage was 13.5%, when people need a home, 7% with tax deductibility compared to the rent that they're paying will look pretty darn good to these millennials. They'll look back at the last 2 or 3 years and know what an aberrational freak it was to be able to borrow free money the last 2 or 3 years.
So Bill, what are you doing right now? How's the portfolio changing? What are you making of the rally that we've seen? How are you playing it tactically at the moment?
Well, yeah, we love the oil and gas business. We love the mall REITs because the millennials, as they buy homes, will spread themselves out across the country. Downtown, big city shopping is dying, and that gets replaced by moving, 20, 30 miles out of town, and it sends you right to our suburban malls at Simon and Macerich. So we like that business. People are afraid of it, and that's good. That's what makes a good investment, is a worthy future with a high degree of pessimism attached to it.
Well, I have to say, Bill is a millennial who bought, I think, 5 more houseplants at Home Depot yesterday for my new apartment here in Washington. I do understand some of what you're talking about. But again, it comes back to the issue that they're warning on profit. They have to pay more people. Which of these businesses has the greatest pricing power to continue to offset those higher costs? Because I know some millennials who are saying, I'm going to stop shopping.
Well, Home Depot and Lowe's have a kind of a duopoly. Right, so from a moat standpoint, Home Depot, other than Ricky Fowler, when you see orange, that's who you think of. So Walmart has Amazon to compete with, but Walmart and Target found out a glorious thing when Amazon went into the grocery business. Having 1,500 stores that are within 15 to 25 minutes of 75% of the United States population is a huge competitive advantage to Amazon. In other words, when you order something on Amazon, they got to spend $5 driving it out to your house. Whereas what he's talking about, when he's talking about the customers taking full advantage, they're ordering a ton of stuff online at both Walmart and Target, and then in 80% of the cases, the customer is going there and picking it up themselves and saving the logistics cost for Target and Walmart.
All right, Bill, we have to leave it there, but thanks so much for joining us. That's Bill Smead, founder, chairman, and CEO of Smead Capital Management. This is Bloomberg.
So at a headline level, European equities not doing very much today, but there's plenty of stories below the surface that are worth paying attention to. European equities trading 463 right now. We're down by 0.1%. The banks are doing well, the real estate companies aren't. Why aren't the real estate companies doing well? Because this is what's happening in the bond market right now. The PMI data super strong, particularly on the services side, encouraging central banks to go further. Yields responding to that. The pound also responding to the very strong data we've had out of the UK. Not only PMIs, but also retail sales numbers. The government finances even look a little bit better as well. Anyway, we're going to discuss all of this next. Graham Secker, Morgan Stanley's chief European equity strategist, is going to be joining us. The close is coming up. This is Bloomberg. Tuesday, February the 21st. European equities at a headline level don't look that exciting today. Below the surface, Credit Suisse is being pounded. HSBC is having a great day. There's plenty of upgrades. There's plenty of downgrades. And we haven't even talked about the data. We're going to do all of that as we work our way through the show. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So here we go. Here are the numbers as we work our way towards the close. Stock 600, 463. A lot of strategists are talking about the fact that the recent rally is set to fizzle. We'll talk about that in a moment. The data, though, today, front and center. UK data very strong, particularly on the services side, particularly on the retail side. Look at this. The UK 5-year is up by 15, nearly 16 basis points. You're seeing a similar story across Europe. The PMI services data bouncing back and bouncing back strongly. What does that tell us about the state of the economy? Single stocks are also fascinating. HSBC is up a lot, but Credit Suisse is down a lot. We'll dig into the details as to why, what information was given by Credit Suisse, particularly by the chairman, in an interview with Francine Lacqua back at the end of last year. Is there an issue with it? Well, the regulators are certainly paying attention. Credit Suisse has a trust issue. That's costing it today 3.5%. Fresh record lows. Kaylee.
Well, Guy, there's some single stock stories to watch here in the U.S. as well, specifically with the retailers that reported earnings this morning. Interesting mixed picture. Walmart was down as much as 3%, now actually higher by about 0.5%, despite the fact that its outlook came up short of analyst expectations. Perhaps investors seeing it as a bit of overcaution when it comes to the consumer, but Home Depot is really feeling its own disappointment. That stock down about 5%. It is not only about the flat comp sales view for the year. They're expecting profit to go down because they're spending $1 billion more on wages for their employees. So that is something to keep in mind. Broadly, as for how that feeds into the U.S. market narrative today, it is a stocks down, yields up story. Both stocks and bonds getting sold. The S&P 500 right now down about 1.4% as we are seeing yields moving higher. 10 basis points on the 10-year to 392. We haven't been this high on that Treasury yield, guy, since back in November. It is a PMI story here in the U.S. as well. Back in expansion territory on that services number with 50.5.
It's amazing. We're seeing similar numbers over here in Europe. Let's talk about the data we got out a little earlier on in the day. France, Germany, the Eurozone, the UK, all popping sharply higher. These are the composite numbers, but the heavy lifting is being done by the services sector, though, to be honest, we're also seeing a pickup in the manufacturing story as well. This is February data, remember. France, 51.6, Germany, 51.1, the Eurozone, 52.3. Remember, this is flash numbers. And the UK, look at that, 48.5 to 53. A really strong bounce back coming through here in the PMI data. An early indication maybe that recessions are not inevitable, but is this a blip? Is this really actually to do with the weather? I keep telling Alex Steele it's all about the weather. She never believes me. But Chris Williamson, S&P Global Market Intelligence Chief Business Economist, whose data this is, certainly pointing us in that direction in the last hour.
Take it with a pinch of salt. The good numbers that we're getting in these winter months are being buoyed by the weather. There's no doubt about that. It's whether you get payback later on that's important. It's going to be interesting to see if this fades or, if we keep having good weather, does it just keep on spending, as it were?
So does it last or does it turn? Because Europe's PMIs clearly are holding up for now, but what about European stocks? Strategists from Bank of America and JP Morgan not so upbeat about the rally we have seen in equities on the continent. Bank of America's Mila Savova saying we remain positioned for a sharp loss in growth momentum over the coming months, while Mislav Machejka at JP Morgan says key monetary indicators are sending warning signs, red flags that should not be dismissed lightly. So that brings us to our question of the day. Will the European rally fizzle out? Joining us now with his answer is Graham Secker, Morgan Stanley's Chief European Equity Strategist. So Graham, what do you say?
I think it depends on whether you're looking at this in an absolute or a relative sense. So the good data we've seen out of Europe today, I think, supports the idea that the European rally relative to other markets, and particularly the US, is likely to continue. Had a little bit of a pause earlier in February, but we're starting to see European outperformance again over the last week or so, and including today. So I think that the European economic data is more supportive for the European